But like with this market rally, like what does this even mean in terms of stage three? Like I honestly I thought when all four indexes went bearish trend, I thought that was the end of stage three, or like the end of that we were reaching the end of stage three. I didn't think that we were going to go to all time highs after that, which is something we said was possible when we came out with the compound landing, and now it's actually looking like it's
I
going
mean,
to happen.
we're not there yet, but we're definitely on the way. And in terms of like the major indices, like Nasdaq is up there. Russell, I mean, like she's got a long way to go. But yeah, the other ones definitely on the way there. So I do think that this move did catch even me by surprise, right? Like I did as well as you. Look, when they were all bearish trend, that was a sign maybe stage three was coming to the end. Obviously, we did not call the end of stage, right? Like we did not say stage three.
Yeah. Well,
Um,
because nothing else was quite lining up yet for stage four.
right, and like I mean, commodities at the time were bullish. They've gone bearish trend, but that's a signal that stage three could be coming to an end, obviously. But it's not really the end all be all like that's going to define no one thing is going to define the progression of this cycle, right? So we have to look at it as a whole, and obviously I laid that out for the members in the members area under the ledger in terms of what exactly needs to happen to get us into stage four, given that we're in stage three right now. So far we haven't really seen much of that click together, so stage three does continue. And listen, as long as the equities are bullish trend, I'm not someone that's going to fight them. Let them go. They can go up. Now, I did say this in the chat earlier this week. It's possible we get a risk-on regime. Always possible. We're not there yet, but if we get a risk-on regime, what's going to happen is you're going to amplify stage three. And I'm not going to say it needs to happen, but in some weird way, it would be ideal if it did happen, because what you end up having right now is you've lifted a lot of perma bears off the lows. You've crushed some all along the way, especially in like the Nasdaq and like the bigger weighted names in the indices, right, that are up phenomenally, like Nvidia, etc. You've crushed a lot of bears, but there's still a quite large amount of bears. And we at Market Radar, right, like we're not really bearish, bullish. We kind of just go with the flow. We are what the tools say to be. So, given that a lot of people just have this cemented pessimistic mindset, I have a feeling like a risk on regime would just get those people rolling, and maybe we see some more capitulation into that soft landing narrative. Now, we've seen soft landing narrative go crazy the last couple of months. I mean, everyone's pretty much on the edge of their seat looking for that soft landing from Powell this week. Powell basically emphasized that the Fed isn't sure it's done enough yet. They believe they're in restrictive territory. They also aren't so keen to back off the gas just yet. While the market's already going ahead and pricing in rate cuts, I don't think that we can be so quick to cut
Yeah, well,
unless we.
what is with the market pricing and rate cuts all of a sudden? What really happened? Nothing broke. Nothing really major happened to indicate that the Fed needs to cut rates soon. So why is the market starting to price that in all of a sudden?
I think the market is overly optimistic on a very easy Fed, right? The market's pretty much betting that the Fed is going to go light, basically, go light with the punches. They're going to rein in inflation, be able to gradually reduce interest rates without doing any type of excessive or overly excessive financial tightening. And something we can do real simply is just look at something like the break-even inflation rate, right? This is down on the floor of the cycle right now. Break-evens are at the floor. They're not below 2%, but they're obviously not where they were a couple of weeks ago or a month ago, excuse me. And they've been pretty much anchored very tightly, showing that the Fed has some sort of control over the forward expectations of inflation by the market, which they didn't have this control back in 2022. and 2021. So they've got a much stronger control on that narrative in the market and controlling inflation. And typically, the idea of the idea of inflation creates inflation. So if the Fed can control the narrative of inflation by being restrictive, they can inherently then control inflation. So I think as long as they stay vigilant with this, the market's going to try and front run the Fed as it always does. And the question is going to be really where the Fed goes from here. I mean, if we look at something like real yields on the long end, they're at 2%, right? So they're still up there. And what the Fed's going to want to do is basically keep real yields restrictive without letting them run away on them. So meaning what they're going to want to do here is they're going to want to make sure that break evens don't fall faster than nominals, because if break evens, which the real yield, right, is just a calculation of the nominal Fed United States Treasury rate minus the expected inflation rate based off of a Treasury inflation protection security. That's how you get the real yield. So if one of those two variables, that real yield, starts falling faster than nominals, than the Treasury yield itself, what's going to happen is this real yield is going to widen, even though the reason why the break-even rate is falling is because it's sensing a slowdown in inflation / growth in the economy. And in that process, you're actually adding financial tightening to the economy as real yields go higher. So the Fed, if we're going to get a drastic slowdown in inflation, which is what people are starting to see, that starting to expect 2%, a two handle, not 2%, two handle CPI prints in the next 6 to 12 months, then they're lower. So people are like, okay, break evens are going to have to come down. And in turn, if nominals don't come down, the restrictiveness is not only going to remain, but actually grow. So the Fed has to adjust that. Now, we're looking at 100 basis points of cuts roughly along those lines. And it's not something that is material in terms of, I should say, the bond trade, you're going to need more than just a gradual reduction in interest rates like that. The bond trade's going to want this economic slowdown.
Yeah,
And that's
like
something
you want an actual collapse where the Fed panics and has to cut to get
I,
a
I
significant
don't
bond trade.
I don't know if the Fed needs to cut, but they need to be more on the gas, right? In terms of, like, they don't need to be like crashing the short term interest rate market in terms of, like, just imploding the Fed funds curve, but they need to be vigilant in cutting, bringing the Fed funds rate from 5.25 to 4.5 isn't going to be the end all be all for the bond trade, right?
Right.
That's not going
Well,
to be the
in that scenario, I think even equities would outperform bonds if it's a very
yeah.
shallow recession.
Yeah, and I think that's what we've been talking about that, right? The last couple of months, the idea that if you are holding on to this recession narrative so heavily, stage 4, right? When we talk about stage 4, we have to be very, very cautious as we progress along the curve of this compound landing, and as we get closer to stage 4, we have to really monitor the situation in the bond market, because if we're facing a shallow recession, a shallow slowdown, then bonds may actually just chop and do nothing. They may be dead security for a while. I mean, yeah, you're going to get paid your yield on TLT, sure, but like in terms of appreciation or in terms of straight momentum, there's going to be no momentum in the bond space for a while. If that's the case, obviously we're not going to be able to see that far ahead just yet. We're still in the midst of stage 3, but it's something we got to watch out for, because if we get there, you're 100% right. Yeah, equities will yield a better risk to reward basis than just chopping sideways in bonds, waiting for the demise or the breakdown in the major breakdown in growth. Until we see that, bonds may just not be it, and that's something that we're watching. If it's specifically in this part of the compound landing, as we get to stage 4, if that move isn't significant enough, and most likely in that scenario, what would happen is the system would actually get the signal that would front run this a little bit and get the signal that there isn't going to be an opportunistic play in bonds, and realize that equities are controlling the space and move there. So we're going to have to see, and that would be obviously through a risk on positioning. So we'll have to see how that progresses and how we get closer to it.
Yeah. And so another thing that's been happening lately is the tens and twos have really been reverting, and they've actually been reverting with a. Has this been a bear steepener move?
No, bull steepener.
This is
So,
bull steepener.
yeah,
Sorry, yeah,
yeah. But I mean, let's also, before we jump the gun, I mean, we're talking about what, 3 days, 4 days?
yeah. It's this could definitely be a fake out, especially with ZB still under Momo. So this got to take this move with a grain of salt, especially because the dollar is down. If we're really expecting deflation to occur, the dollar is not going to be moving the way it's moving right now.
Right. So the dollar going bearish trend is obviously, you're right. It's very important, like, to look at stuff like this and understand that stage four is a roadmap. So the idea behind stage four is really simple. It's that the Fed will not be able to engineer a soft landing, which means we're not, most likely they're going to be overly restricted for too long, and we're not going to get out of this scot free, right? But that doesn't mean that the hard landing is the Great Depression. And a lot of people they have a hard time coping with that. They're like, man, we need the depression. We need the great financial crisis. We need, the COVID crash. We need to reset. We need to reset the economy. All this types of
It
wild.
always blows my mind when people are like that. Like there's so much hardship that comes with that, and I can almost 100% guarantee that those people that are saying that and wishing for that are not going to even take the trades that are profitable during that time.
What's funny is these motherfuckers talking about this stuff. They have no idea what the Great Depression even looks like. They're like, oh yeah, we need to reset the economy. We need, mass layoffs to fix it. We got all this zombie economy. You, like, what they don't understand is what comes with washing out that zombie economy. They don't understand. Like, they think they understand, but they don't. Because without, you're not going to be able to, look, you can't wash out a zombie economy with QE, excuse me. Like, let's be honest. If there is a financial crisis, however large it may be or significant it may be, you're going to get QE. It's going to happen, right? The Great Depression was just, there was no backstop, right? Even in these crashes in the 40s, 50s, or whatever, 60s, there was no backstop. Now we have the backstop of the Fed, and the Fed will step in. The Fed will always be the buyer and the buyer of last resort in the economy like this.
Yeah, and especially now that we're in a situation where inflation really is tamed, they have QE kind of back at their disposal. Maybe not right now. They can't just come out right now with QE, but if we do get deflation, we do get a recession.
They're spinning the block. They're spinning the block. It's
100%. Yeah. They'll be able to use QE without pumping up inflation again to the point that we had it, unless they go absolutely crazy, which I don't think they'll go as crazy as they did with COVID.
Yeah, look, I'm all for keeping a balanced economy. I understand. Look, the workforce, the economy, business is not easy. I know firsthand. This is not something. It's not a layup. None of this is a layup. It's hard work. Sometimes you fail. Sometimes you go bust. It's part of the game, right? Trust me. I understand. It's just there is this perception that, I don't want to get political, but it's almost that all risk takers need to feel punishment. It's this idea that you started a business, it's time to feel pain. And it's not everybody, but a lot of people think that, the crisis needs to come. And then sometimes the crisis is not, sometimes what ends up happening is the crisis comes and goes, and before you realize it, it's already happened. And you were looking at the wrong spot at the wrong time at the wrong magnitude to even realize it happened. And what I mean by that is sometimes the crisis is not a crisis at all, but you think it is. And simply put, sometimes the worst case scenario, most of the time, is not the most probable scenario. And I think we have to always keep an open mind. That's the beauty of the stock market, right? And the economy is that we have these complicated and precise models, but at the end of the day, they only are as good as the people that use them. And if your mind is closed using them, and just in general, what ends up happening is you take a lopsided approach, and just because it's risk on or risk off, you think that it's the end all be all. That's it. So it's done. Risk off. Okay, we're going to new lows and new equity lows, and we've been very adamant about that, saying that if this economy doesn't slow down and can't outprice the 2022 low, it can't outprice that 2022 situation, excuse me, the equity market won't make new lows. I mean, we've been saying that pretty much all year. So, and that's something that's I think has been holding true and will hold true unless stage 4 is as severe as you'd expect. Some of these people would imagine it to be. There's a shot that we don't see those lows. Could the Nasdaq go down to 13,000 or 12,000? Sure, but for us to take out those lows, we're going to need some serious economic damage. Could that happen? Very well. That will have to be seen in stage 4.
It would be a very different situation than what brought us down there in the first place, where that was a very inflationary recession that brought us down there. If we do get stage 4 and a deep stage 4 recession, that's going to be a deflationary pressure bringing us down there. So even that is going to complicate things because it's not going to be an easy comparison to the situation that we had there.
Right, so that's where the system will come into play, right? Because like as stage 4 progresses and we get there, the system will guide us in terms of how we're going to position either equities or, let's just say the system decides that stage 4 is a risk-on environment for whatever possible reason and puts us into equities, however that is, right? However that plays out, the system will likely pick the path of least resistance. So if it's a stage 4 with a good bond positioning, most likely what's going to happen is interest rates will come down significantly. Which is pretty much what most people are expecting. But I just have this weird feeling that stage 3 can beat on a little bit more, even with commodities in bearish trend. We still don't have enough of the stage 4 requirements met that were listed in the ledger to really qualify to even be close to stage 4 just yet, which means stage 3 can continue. And I think a lot of people are just, they're not capitulating. They think that the economy is going to fall apart any day now. And I think that they are going to be proven wrong. And I mean, until we get that stage 4 positioning signal, and unless it's risk off, the equity indices are bullish trend, the ES and NQ, and they'll grind higher and more people will get infuriated, throw the towel in. Maybe that's what we need for the soft landing peak. I think that's we're in the back quarter of stage 3 right now, the last quarter of stage 3, excuse me. So we're in that phase where like we could have just hit peak, or we could be we could be on the ramp to peak stage 3 pricing. So I think you have to be vigilant with that.
Well, maybe it has to do with the reverse repo market. So people have been saying, we did have a podcast talking about this. The reverse repo.
Weeks ago, right?
Yeah. So people are waiting for the reverse repo to hit zero, all of that liquidity getting drained out, and then calling that the start of the recession or the beginning of the end, pretty much. Maybe that's what we'll see. What do you think about that?
We went over this last time in the last podcast, but I'll reiterate it that just because the reverse look, the market functioned for years with barely anything in the reverse. Okay, we're talking about 200 billion in the reverse. Throughout 14, 15, 17, right? 200, 400 billion max.
Yeah.
Okay, we're at 700 billion. If this thing goes down to 400 billion, I don't think we're in a new environment. I think this is status quo. We're actually just getting back to the starting line. I don't think we've made major improvements here in terms of like, this is just a reset to normal. I think what people are talking about with the reverse repo is they're saying, look, this excess liquidity is basically cushioning, is allowing the Fed to do QT under the surface, and they're not really putting a strain on the economy, because this, instead of draining bank reserves, they're really just taking the reverse repo balance. The Fed's draining the reverse repo balance instead of actual bank reserves, which theoretically, yes, this is true. The only problem is I think that the Fed doesn't even care. The Fed's not even focused on this. What the Fed's looking at is this. The Fed is worried about the pressure in the short-term funding market based on the short-term overnight, the secured overnight funding rate, which is SOFR. And as long as this rate is anywhere near this green line, the overnight reverse repo rate, I think we have zero problems with ending QT. I think QT beats on very loudly until this black dot, this SOFR line, gets well into the red area. Until that happens, I think the Fed is going to just continue to run QT. I don't see why they would stop. I mean, the Fed's balance sheet is at Sorry, the Fed's balance sheet is 7.7 trillion, 7.8 trillion. They're down greatly since the 2022 peak, but I mean, look where we've gone since
Yeah,
COVID.
I mean they've
I
got a
mean,
way to go if they want to fully normalize back, which I don't
I
even
don't
know
think
if.
that I don't even think they do a degree, right? They're not going to want to completely inverse the inverse. I mean, maybe they do, so somewhat, right? They
Do
want
you
to
think
take.
it's even possible for them to go back to where they were before COVID?
Do I think that's possible? Huh. Yeah, yeah. I mean, you're talking about
You actually think that's
so.
possible?
Well, I mean, do I think it's probable or do I think it's possible?
Do you think it's okay? Do you think it's probable?
No, it's not probable. Do I think it's possible? Of course. So if to understand the balance sheet dynamics, what you have to understand is the QE to the QT to QE dynamic, right? So we've only seen this happen once, uh, tw- uh, twice-ish, right? And the way it works is QE starts in 2008 substantially, right? I mean, the balance sheet was going up ever so slightly before then, and then just explodes, all right? And starts going up. And then this like pause happens. And eventually what ends up happening is the balance sheet drops, right? Ever so slightly, comes down, but it's supported in the 2012 era. It wasn't, they weren't really trimming the balance sheet as they did in starting in like the 17-18 area, but it rips up again. And then same thing happens here at pauses, and they actually start reducing the balance sheet in 18. But unless they can reduce the balance sheet at a faster or a more consistent rate than they can increase the balance sheet in times of hardship or times of stress, what's going to happen is this balance sheet's going to forever go up, right? Because let's just say they let this thing fall at its 60 something billion dollars a month. You can actually even just see it here. Look at a month, right? We're doing about 100 something billion a month on the balance sheet coming down, right? If they can keep that going, and in a QE era, they can, they add 5 months of tightening. They reverse 5 or 6 months of tightening, and then they go back to tightening again throughout the next cycle. 100% we can go down. But the problem is like, let's be honest here. If there's any sign of economic stress, you think they're only going to reverse 5 to 6 months of tightening?
Yeah, they seem to kind of just throw as much money at the problem as they can.
Yes. And that's unfortunate because I don't think I'm not a firm believer that the economy needs this type of balance sheet to run itself. I really do think that the stock market for a very long time has functioned without QE in terms of the Fed's balance sheet, and I think that if we needed it, and it depends where. Like the GFC, yeah, I think to a degree you could claim that you needed it. COVID, you can claim that you did need it. But did you need this from 2020 all the way to 2022? This need to grow from 6.8 trillion to 9 trillion? We are still not to the point to where the balance sheet actually started climbing after COVID. The balance sheet went up in a straight line because of the mass liquidity injection, and then it rose. We're not even at the post-COVID top, where I shouldn't say post-COVID top. We're not even to the point of the primary liquidity injection after COVID, meaning COVID happened, they injected $3 trillion, whatever it was, and then it rose another $2 trillion on top of that. We still haven't erased the first $2 trillion. We got 5 something trillion to go. Like, you see what I'm saying, right? Like we haven't even taken back half of this COVID move. So it's just like we got a long way to go, and I think that the Fed is going to just stick to their number because the way the Fed operates is pretty simple. They look at the scenario and they go, look, we set up 100. As we just saw, we're cutting 100 billion a month off this. The market. Look at the S&P 500. We're near all time highs. So the market's okay with this,
Yeah,
and the
yeah,
market knows that this is not going to stop. I mean, well, the market's going to price rate cuts right now. This is the other dynamic we got to bring up quickly. Everyone's talking about rate cuts. What happens to QT? Are we going to see? Is this going to be the first time in history the Fed's going to actually reduce interest rates while running QT?
that would be an interesting scenario.
I don't think it's going to happen, but listen, obviously I think that's more possible than us getting back down to pre-COVID levels on the balance sheet.
Yeah,
So that would be interesting to see. But I think we got to just keep our eyes out and watch the secured overnight funding market, and just basically see where this is the pressure's coming in. And obviously, we've yet to see any real pressure on the upper end of the bound here, which is telling the Fed. The Fed looks at this chart, by the way, and it's just like, all right, all is clear. Sky's clear. No problems here. Literally.
Yeah.
Balance sheet doesn't matter. It doesn't matter. There's enough. The reverse repo doesn't matter. None of this matters. This is what matters. They're like, okay, there is ample supply. Now, this could easily start to, once the reverse repo is done, is completely drained, we could actually start to see this kick up faster. That's a possibility. But until we see this really kick up, we can just look back and rely on this and say, you know what? No stress, no worry for the Fed at the moment in terms of ending QT. That's going to rage on. And until that ends, you are going to have a negative headway across across the liquidity spectrum in the market.
All right. That's well said. I think
All right, so
we can end it there.
We'll wrap up the pod here. Thanks, guys, for listening. If you have any questions, feel free to reach out to us on our Twitter at The Market Radar, or you can go to our website to find more about our products and services at market-radar.com.